Hello, this is Craig Mitchell, your personal mortgage consultant for life. And this video that you're going to watch today is an excerpt from one of my first-time homebuyer seminars. So if you're a first-time homebuyer, this is information you definitely need to know. And even if you're not a first-time homebuyer, I can almost guarantee that most of the information will be new to you, so you can definitely benefit by watching it. If you do have any questions or comments after watching the video, please email me or call me, and my contact information will be provided at the end of the video. Alright, so today we're going to talk about first-time homebuyer loans and what the requirements are for you to qualify for one. Now when you hear about first-time homebuyer loans, most of the time what they're talking about are FHA loans. FHA is part of the federal government and stands for Federal Housing Administration, and their sole purpose is to promote home ownership. And that's the reason FHA was created, is to help people just like you to buy a home. Now most people that get FHA loans are first-time homebuyers. However, even if you're not a first-time homebuyer, you still can qualify for an FHA loan. There's three reasons that FHA loans are so popular. Number one is a small down payment. In many cases, you can get an FHA loan with very little money out of your pocket, and in some cases, for no money out of your pocket at all. Number two is you do not need good credit to qualify. To get an FHA loan, you only need mediocre credit. And even if your credit is really bad, it's very simple to improve your credit in a very short period of time if you know what to do. And I actually explain in detail how to do this in one of my other videos. And the third reason FHA loans are so popular is you do not need to make a lot of money to qualify for one. Now let me explain how FHA works. FHA does not actually lend you the money to buy a house. FHA is basically just a government insurance company that insures your loan. The money actually comes directly from a bank. And almost all banks and mortgage brokers are registered with FHA, so really you can go to any bank or mortgage broker in the United States and 99% of them can do an FHA loan for you. So the way it works is the bank lends you the money and FHA simply insures the loan. So what exactly does it mean for FHA to insure the loan? Basically the way it works is as long as the bank follows FHA guidelines when lending you the money, the government will insure the loan and the bank has virtually no risk at all of losing any money. And that's why banks love FHA loans, is it's like free money for them. They can't lose. If it looks to the bank like they're going to lose money because they have to foreclose, well then they just send that loan to FHA and let FHA take the loss and the banks are off the hook scot-free. So you're probably wondering, where does FHA get all its money from to pay for all the losses that sometimes occur from foreclosures? Well, when you buy a house with an FHA loan, you have to get what's called mortgage insurance that you pay through your monthly payment. So let's jump right to an example to show you how much this would cost you. For this example, let's say your loan amount is $200,000. Well, the mortgage insurance from FHA comes in two parts. You have an upfront premium and you have a monthly premium. The upfront premium is 1% of the loan amount. So if you're buying a house for $200,000, 1% of $200,000 is $2,000. So your upfront mortgage insurance is $2,000. Now don't worry, you don't pay this $2,000 out of your pocket, it just gets added to your loan amount. So if you borrow $200,000, then and the mortgage insurance is $2,000, then you would have a loan amount of $202,000. So it's $200,000 that you borrowed plus the $2,000 for mortgage insurance equals $202,000, and that's what you would pay back on the loan. Now aside from that $2,000 upfront premium that FHA charges, you also have a monthly insurance premium which is 0.9% per year. So 0.9% of a $200,000 loan is $1,800 per year, and if you divide that per year by 12 to get your monthly payment, that's a monthly payment of $150 per month. So every single month when you make your mortgage payment, $150 of that goes directly to FHA. And that's how FHA makes their money. They get that $2,000 up front plus $150 per month. Now you have to pay this monthly premium of $150 per month for roughly 7 years. After 7 years, you can apply to get that monthly premium removed. Now, if you're like me, you're probably thinking, well, how do I get around paying this $2,000 up front and this $150 per month for the next 7 years, because that's a lot of money? Well, the only way to get around paying the mortgage insurance is to put up a big down payment of at least 20%. So on a $200,000 house, you would have to put a down payment of $40,000 to avoid all this mortgage insurance. Well, most people don't have that kind of money sitting around, so what it boils down to is if you want to buy a house and you don't have 20% for a down payment, then you are going to have monthly mortgage insurance, and there's just no way around it. And you know what? 90%, that's 9 out of every 10 first-time home buyers do get an FHA loan, and they pay this mortgage insurance because, you know what? It's still a heck of a lot better than renting. So that brings me to the next question is, how do you qualify for an FHA loan? Well, really there's two big requirements for FHA. The first requirement for FHA is that you have to put down 3.5% of your own money towards the house. So on a $200,000 loan, that means you would have to put down $7,000. And on a $100,000 loan, that would be $3,500. And if you're having trouble coming up with the down payment, there are some what are called down payment assistance programs that can help you out with that. And I actually covered down payment assistance programs in another video. The second big requirement of FHA is that you have to document your income for 2 years. Basically, this means that you have to be currently employed and have a total of 2 years work history. So if you've been at your current job, for example, for let's say 6 months, then what we would have to do is show that you worked somewhere else prior to your current job for at least 18 months. So 18 months and 6 months would be 2 years. And to clarify this a little further, your 2-year work history does not have to be consecutive. So for example, if you've only been on your current job for 6 months, but your last job was over 5 years ago, well, all we would do is go back 5 years and count that previous job towards your 2-year work history. So really, you're only required to have a 2-year work history in your entire life to qualify. And that's pretty much it. As you can see, it's really not too hard to qualify for an FHA loan, which is probably why they're so popular.